While market participants debate the extent of the US economic slowdown this year and the potential dollar impact, we should not ignore the long-term structural negative factors for the dollar. We believe these factors are playing a role in limiting dollar appreciation. As we've highlighted before, since Donald Trump's election victory, the Federal Reserve's major currency dollar index has declined by 1%. One consequence of a Trump presidency is the notable deterioration in the outlook for the US fiscal deficit. Combined with the current account deficit, the so-called twin deficit in the US could widen out to nearly 7% of GDP this year. This is in sharp contrast to the German twin surplus of around 8% of GDP. The Congressional Budget Office recently updated its budget projections. These show budget deficits exceeding $1 trillion every year from 2022 onwards. The US is already in uncharted waters, with the budget deficit now worsening despite the continued economic expansion. These growing budget deficits will require financing, a burden reinforced by the Fed's $360 billion worth of reduced US Treasury bond buying this year. This additional financing burden requires investors switching from risky assets, financing from domestic savings, or financing from abroad. Current cross-border flow data suggests foreign investor appetite for long-term US bonds is diminishing. US Treasury data indicated just $14 billion worth of US Treasury bond purchases in the 6 months to November. ECB portfolio data shows zero foreign bond buying by Eurozone investors in the last 3 months, and just 45 billion euros worth of purchases in the last 6 months. That's the smallest total in nearly 5 years. With the Fed on hold for now and the US economy decelerating, a weakening US dollar will be a requirement in the financing of the US's widening twin deficit.